Here's something that will blow your mind. VOO and VFIAX hold the exact same 500 stocks, SPY and FXAIX. Same thing. Yet financial Twitter is a war zone over which one is better. One camp screams ETFs are superior, while the other swears by index funds. They're arguing over vehicles that literally invest in identical companies. It's like fighting over whether a red car or blue car gets you to work faster when they're both Toyotas with the same engine. Today, I'm breaking down the 3 critical differences that actually matter and which one is right for your money, because spoiler alert, this decision won't make or break your wealth, but understanding it will save you from analysis paralysis that keeps you broke. Section 1. Definitions and similarities, 030 to 230. Let's start with what these things actually are, because most people are confused from the jump. Both ETFs and index mutual funds are baskets of stocks. When you buy one share of VOO or one share of VFIAX, you're not buying Apple or Microsoft individually, you're buying a tiny slice of 500 companies all at once. It's instant diversification in a single purchase. Instead of spending hours researching which stocks to buy, you're getting exposure to entire markets with one click. Think about it this way. Imagine trying to build a diversified portfolio manually. You'd need to buy shares of Apple, Microsoft, Amazon, Google, Nvidia, Tesla, and 494 other companies. You'd need thousands of dollars just to get started, and you'd spend weeks rebalancing every time a company's weight in the index changed. Index funds and ETFs do all of this automatically for you. One purchase, and you own a piece of the entire American economy. Here's what makes them almost identical. Both usually track an index, the S&P 500, the total stock market, international stocks, whatever. They're following a recipe. If Apple makes up 7% of the S&P 500, then both VOO and VFIAX will hold roughly 7% Apple. They move together, they rise together, they fall together. Both have insanely low expense ratios. We're talking 0.03% to 0.04% annually. That means for every $10,000 you invest, you're paying $3 to $4 per year in fees. Compare that to actively managed funds that charge 1% or more, and you realize why index investing became a revolution. Over 30 years, the difference between a 0.04% fee and a 1% fee on a $100,000 investment could be over $50,000. That's a down payment on a house, just evaporating into management fees. Here's the key mindset shift you need. ETFs and index funds are the vehicle, not the destination. Whether you take a bus or a train to New York City, you still end up in New York City. The transportation method matters less than the fact that you're actually making the trip. Most people waste months researching the perfect fund while their cash sits in a savings account earning nothing. The real enemy isn't choosing the wrong fund, it's not investing at all. Section 2, Difference 1, Trading Mechanics, 230 to 5. Now let's get into the actual differences, starting with how you buy and sell them. This is where things start to matter. ETFs trade like stocks. You can buy or sell them anytime during market hours from 9:30 a.m. to 4 p.m. Eastern. The price fluctuates throughout the day based on supply and demand. If you check VOO at 10 a.m., it might be $437.38. By 2 p.m., it could be $437.85 or $436.90. You can watch it move in real time, place limit orders, even short sell them if you're feeling risky. Index mutual funds like VFIAX trade once per day after the market closes. It doesn't matter if you place your order at 9 a.m. or 3:59 p.m., everyone who bought that day gets the same price, calculated at 4 p.m. when the market closes. This is called the net asset value, or NAV. It's the total value of everything the fund owns, divided by the number of shares. No intraday price swings, no watching ticker symbols. You place an order and wait for the end of day price. Here's where this gets interesting for automatic investing. Index mutual funds have historically been the king of set it and forget it. You could set up automatic investments where $500 gets pulled from your checking account every month and automatically buys VFIAX. Fractional shares made this seamless. You didn't need to worry about share prices or having leftover cash. Let's say you set up a $500 monthly investment into VFIAX. If the share price is $387.42, you'd get exactly 1.2907 shares. Every penny is invested. No waste, no leftover cash sitting around. This is massive for long-term wealth building because every dollar is working for you immediately. ETFs were trickier. If VOO costs $437 per share and you have $500 to invest, you could only buy one share, leaving $63 sitting uninvested. That uninvested cash compounds into real money over decades. But that's changing fast. As of January 2025, Vanguard now allows automatic investments into ETFs. Many brokerages like Fidelity and Schwab already offered fractional ETF shares. The gap is closing. The automation advantage of mutual funds is disappearing. But here's where ETFs shine for control freaks. Limit orders. Let's say VOO is trading at $437, but you only want to buy if it drops to $430. With an ETF, you can set a limit order. Your purchase only executes if the price hits your target. With a mutual fund, you have no control. You get whatever the closing price is that day. For long-term investors who buy monthly regardless of price, this doesn't matter. For people who want precision timing, ETFs win. The trading difference creates a psychological trap though. Because ETFs trade all day, they tempt you to check prices constantly. You start thinking like a day trader instead of a long-term investor. You see VOO down 2% at 11 a.m. and panic. The mutual fund's once-a-day pricing actually protects you from your worst impulses. You can't panic sell at 2 p.m. because the market dipped. You're forced to wait until 4 p.m. and often by then, you've calmed down. Sometimes limitations are features, not bugs. Section 3, Difference 2, Tax efficiency, 5 to 7. This is where things get spicy, because taxes can silently destroy your returns over decades, and most people have no idea this is even happening. ETFs are generally more tax efficient, and it's because of how they're structured. When you sell an ETF, you're selling it to another investor on the stock exchange. The fund itself doesn't have to sell any stocks to give you your money back. But when lots of people redeem a mutual fund, the fund has to sell stocks to raise cash. Those sales can trigger capital gains, and those capital gains get distributed to everyone who owns the fund. Even if you didn't sell anything, you could own FXAIX, never sell a single share, and still owe taxes because other people redeemed their shares. Let me give you a real-world example. Imagine you own a mutual fund, and the market crashes. Panic sets in, and thousands of investors sell their shares. The fund manager has to sell stocks, often at the worst possible time, to meet those redemptions. Those sales create capital gains, which get passed to you, the loyal investor who didn't sell. So you lose money from the market drop, and you get hit with a tax bill. It's a double punch. ETFs use something called in-kind creation and redemption. When big institutional investors want to redeem ETF shares, they get actual stocks instead of cash. No sale happens, no capital gains triggered. It's a structural advantage built into how ETFs work. This is why you'll see most ETFs have zero capital gains distributions year after year, while even index mutual funds occasionally have small distributions. Now here's the plot twist. If you're investing in a Roth IRA or 401k, this doesn't matter at all. Tax-advantaged accounts don't care about capital gains distributions. Everything grows tax-free or tax-deferred anyway. The tax efficiency advantage only applies to taxable brokerage accounts. And then there's the Vanguard exception. Vanguard had a patent that expired in 2023, which allowed their mutual funds with ETF share classes to flesh out capital gains through the ETF structure. VFIAX benefited from having VOO as its sister fund. This made Vanguard's mutual funds just as tax efficient as their ETFs. Other companies are starting to copy this now that the patent expired, but Vanguard had a 20-year head start. The verdict: in a taxable brokerage account, ETFs usually win on taxes, but if you're investing through a Roth IRA or 401k, which you should be maxing out first anyway, the tax difference is zero. Don't let tax efficiency be your deciding factor if you're investing in retirement accounts. Most beginners should prioritize tax-advantaged accounts before even thinking about taxable brokerage accounts. Section 4, Difference 3, Minimums and Costs, 7 to 9. Let's talk about money. Not returns, but the actual cash you need to start. Because the best investment strategy in the world is useless if you can't afford to begin. Most index mutual funds have minimum investments. Vanguard's VFIAX requires $3,000 to start. Fidelity's FXAIX has zero minimum, which is awesome, but not all fund companies are that generous. If you're just starting out and only have $500, that $3,000 minimum can feel like a wall. It creates a waiting period where your money sits in a savings account, earning almost nothing while you slowly save up to hit that minimum. ETFs have no minimums beyond the price of one share. VOO trades around $437. That's your minimum. And with fractional shares now widely available at brokers like Fidelity and Schwab, you could invest $50 and own 0.11 shares. The barrier to entry is effectively gone. You could start investing today with whatever you have. Now let's talk expense ratios, because this is where people obsess over pennies. VOO has a 0.03% expense ratio. VFIAX has 0.04%. That's a difference of 0.01% or 1 basis point. On a $10,000 investment, that's $1 per year. Over 50 years with compounding, it adds up to a few $1,000s, but we're not talking life-changing money. Let me put this in perspective. If you invested $10,000 in VOO versus VFIAX and both grew at 10% annually for 30 years, the difference in fees would cost you around $2,000. That sounds like a lot until you realize both accounts would be worth over $174,000. You're arguing over 1% of your total wealth while missing the bigger picture. You're building generational wealth either way. SPY, the oldest and most traded S&P 500 ETF, has a 0.09% expense ratio. FXAIX is 0.02%. That's a bigger gap, but both are still dirt cheap compared to actively managed funds that charge 1% or more and statistically underperform the index anyway. Here's what actually matters. Don't chase the absolute lowest expense ratio if it means investing in a fund you can't automate or one that doesn't fit your platform. The difference between 0.03% and 0.04% is noise. The difference between investing consistently for 30 years versus not investing because you're paralyzed by choice is everything. Hidden costs matter more. Some brokers charge commissions on certain ETFs. Trading costs, bid-ask spreads for thinly traded ETFs, and brokerage fees can dwarf expense ratio differences. Stick with major, highly liquid ETFs like VOO, VTI, SPY, or index funds from Vanguard, Fidelity, and Schwab. They all have massive assets under management and tight spreads. You want funds with billions or trillions in assets because that liquidity protects you from unnecessary costs. Conclusion, 9 to 11. Here's the truth nobody wants to hear. VOO and VFIAX will make you the exact same amount of money over 30 years. The performance difference is microscopic. They track the same 500 companies. They have virtually identical returns. If you invested $10,000 in each on the same day and held for 20 years, you'd be hard-pressed to find more than a few $100s difference between them. The real question isn't which one is better, it's which one fits your life. Choose index mutual funds if you want true set-and-forget automation. You're investing in a retirement account where taxes don't matter, and you prefer the simplicity of dollar-cost averaging without thinking about share prices. They're perfect for beginners who just want to invest $200 every month and never look at their account. The forced once-a-day pricing removes temptation to constantly tinker. Choose ETFs if you want more control with limit orders. You're investing in a taxable account where tax efficiency matters. You like the flexibility of trading throughout the day, or you're working with a platform that makes ETF automation easy. They're great for people who want precision and lower costs without sacrificing long-term discipline. But here's what will actually make you rich: buying them consistently for decades, not timing the market, not switching between funds every year chasing 0.02% lower fees, not waiting for the perfect entry point. The paralysis by analysis trap has cost more people more money than any expense ratio ever will. I see people spend 6 months researching whether to buy VTI or FXAIX while inflation eats their cash. Meanwhile, the person who just bought either one 6 months ago is already up because they actually invested. Let me tell you about two investors. Sarah spent 3 months analyzing every S&P 500 fund, reading white papers about tax efficiency, calculating expense ratio differences out to 40 decimal places. She finally invested in VOO. Mark read one article, picked VFIAX, and invested the next day. 30 years later, they both retired millionaires. The only difference? Mark had 3 extra months of compounding because he didn't overthink it. The best investment vehicle is the one you'll actually use. If automatic investments into VFIAX mean you'll consistently invest without thinking, that's the winner. If buying VOO with limit orders keeps you engaged without overtrading, that's the winner. The perfect plan you don't execute is worthless. The good plan you actually follow builds wealth. Don't get caught in the Reddit threads arguing about basis points. The real wealth is built by people who pick a solid index fund. ETF or mutual fund doesn't matter. Automate their investments and ignore the noise for 30 years. That's the strategy that's created more millionaires than any perfect fund selection ever will. You know what doesn't make you rich? Waiting, researching endlessly, trying to time the perfect entry, switching strategies every time you read a new article. The market rewards action and patience, not perfection and hesitation. So here's your action step. Open a Roth IRA if you haven't already. Pick either an S&P 500 ETF like VOO or an S&P 500 index fund like VFIAX. Set up automatic monthly investments. Then forget you even have a password to that account for the next decade. Start with whatever you can afford. If it's $50 a month, great. If it's $500, even better. The amount matters less than the consistency. A person investing $300 monthly for 40 years at 10% average returns ends up with over $1.5 million. That's retiring comfortably, traveling the world, leaving an inheritance. And it doesn't matter if they used an ETF or a mutual fund, because the difference between ETFs and index funds won't make you rich. But investing in either one consistently, starting today, absolutely will. The best time to start was yesterday. The second best time is right now. Stop researching. Start investing.